I'm Brendan, Sharesies Country Manager in Australia. And we're lucky enough to have one of my favourite humans with us today, multi-award winning financial advisor, now retired, founder extraordinaire, parent to some of the cutest pets on Instagram, and best-selling author from She's on the Money, Victoria Devine. Welcome, Victoria.
Hello, I'm so excited. I'm only your favourite person because we're both cat people, but we'll overlook that and pretend it's got something to do with investing.
All of that, but yes, cat people forever. So everyone, we've heard from you that you enjoy our Q&A sessions, so we thought we'd pull together some of the most popular questions that we've had to help you on your investing journey in 2023. So we'll answer these questions as best we can, and we want to be as helpful to you as possible. So before we get started today, I'd like to acknowledge the traditional custodians on the land on which we come from you today, the Gadigal people of the Eora Nation, and pay my respects to the elders, past, present, and emerging. I also extend that respect to Aboriginal and Torres Strait Island peoples here today. And a special shout out to Amy Allerton, who is the artist behind the beautiful art on the screen, which we commissioned called Shall We Grow Together. So check out Amy on Instagram at Amy Allerton or Indigico Creative. So just a bit of a recap on Sharesies. So our purpose at Sharesies is to create financial empowerment for everyone. And one way we do this is through our investing platform. There are over 500,000 investors across Australia and New Zealand on the platform, and we have over $2 billion funds under management. Now, the great thing about that is many of our customers thought that investing was just too hard for them, too complex, or just too scary. But we exist to make investing easy and accessible. So if you're already a Sharesies customer, thanks for being with us. And if you're not yet, stay to the end for a special offer. So our vision is to give someone with $5 the same opportunities as someone with $5 million. So we offer access to the Australian, New Zealand, and American share markets. There's no minimum investment on our platform, meaning you can buy part of a share. So you can literally invest from 1 cent. We're also a proud member of the B Corp community, which is companies who are committed to using business as a force for good. So before we start, I just want to remind you that investing involves risk. You aren't guaranteed to make money, and you might lose the money you start with. Any information we provide is general only and current at the time we provide it. If you're looking for more specific help with your investment choices, we recommend talking to a licensed financial advice provider. And we won't be giving any personal advice or recommending any particular investment choice or financial product as part of the session. And if we mention any particular investments, it's just for an example, not a recommendation. So a bit of interactivity now. One of the key ways to get started on your investing journey or stay motivated with investing is to set goals. So seeing as we're in the early days of 2023, although it feels like we're halfway through it, I'm keen to hear what your investing goals might be and how you're tracking towards them. Whether it's reading Victoria's books or investing in an exchange-traded fund to start out your investing journey or diversify your portfolio, we'd love to hear it. And some of your answers might even spark inspiration for everyone else. Victoria, what investment goals have you got?
Yeah, this is a tricky one because I've tried for a very long time to be really consistent with my investments. But if you have been following me on social media, you know that I have been renovating my house. So a lot of our surplus cash has been going towards there. And I'd pulled back on how much I was investing because it just wasn't feasible. So this year, I really want to be able to turbocharge that a little bit more than I had. And yeah, plot along with what I have already been doing. I'm quite a conservative investor. I'm not somebody who takes too much risk. I always like to say that I'm an aggressive conservative investor in that I like to have a lot of my assets in the share market, but I also pick really tried true blue chip assets because I'm quite conservative in that aspect. So I think, yeah, for me this year, it's all about just getting back on track with the investing goals that I have had. And as always, I think everybody knows this already if you have met me before, but my investing goal is actually just to create financial freedom. I'm not investing towards a particular asset to purchase. I actually just want to create passive income in the future for my family and I. And that's, yeah, the main priority. We're still a very far way off, Brendan, but from little things, big things grow. So I'm excited about it.
I love that. I think my investing goal this year is to work out these interest rate raises and how that kind of impacts everything. It was like, I need to redo my budget. It's like, when you look at stuff, it's like, ooh, that interest rate bumping out, it's starting to make a dent.
I feel like interest rates are something that we can't have our heads in the sand about anymore. Personally, I have a mortgage and my mortgage repayments have doubled over the last 9 months. And we're in the fortunate position where shifting our budget has meant that, we can make that happen, but it's going to be a bit of a stretch if it goes any further. I think that there will be compromise having to come into it. And I know a lot of people are in that position at the moment. So it's a really good conversation to have.
And that kind of leads into the next thing I just want to talk about, which if you follow us on socials, you would have seen me put a few questions out in the last couple of days to test financial literacy. And these questions came from a 2020 survey which looked at financial literacy across Australia, which paints a less than rosy picture. And it shows that the average score of Australian males fell from 4.1 out of 5 to 4. But most importantly, the average score of Australian women, already lagging way behind men, slipped even further from 3.7 through 3.5. And that gender gap keeps widening. So it's really, that's really disappointing, I think. And in terms of age groups, Australians aged between 15 and 24 had the biggest decline in financial literacy of all age groups, with their mean score dropping from 3.4 to 2.9 out of 5. So that feels doom and gloom, but it's not all doom and gloom. There are plenty of resources out there to help people with financial knowledge, like coming to these webinars, articles and go-to guides on the Sharesies website. We've got She's on the Money podcast, excellent blogs that Victoria and the team put out, and your supportive community, and also websites like Assets Money Smart. Victoria, as someone who's founded one of the most engaged and financially savvy communities in Australia, are you survived by those stats? And kind of what tips would you give people to help prioritise and stay on top of financial literacy?
I was really upset when I saw that we'd been going backwards. I think having existed in a community like She's on the Money and been in the grateful position where it's grown over the last 3 years exponentially, I just assumed that also meant that financial literacy across the board was growing. And unfortunately, that's not the case. I do feel like COVID has a lot to play into this, in that people are stepping back, and I use the term putting our heads in the sand all the time, but I think during COVID, especially when it came to money and financial literacy, we did go backwards. And talking about the demographics, like if we talk about the age of 15 to 24, they're the ones that had the biggest decline in financial literacy out of all of the age groups. And that, from my perspective, that story really does check out, because they have been out of the real world for the last 3 years. And once you turn kind of like 13, 14 and you're starting to learn about money, maybe you got your first job, like that's where financial literacy really starts to kick in. And I genuinely think that having had COVID happen, it's kicked us to the curb, and kids aren't able to do the financial literacy that they were able to do before, like setting up bank accounts and starting to have conversations about superannuation and starting to, do a little budget and manage things, even if it wasn't necessarily a whole family's budget. So I think it's, from my perspective, really disappointing. But the Hilda survey has been done year on year on year. I mean, the last one was done, I think it's done every 4 years, was done in 2016, and then it was done again in 2020. And hopefully it will be done again in the next few years. Maybe early would be good, given it slipped. But yeah, I'm not surprised, but I am really disappointed, because it's kind of heartbreaking to find that we're slipping, because especially women, like for men to go back 1 point and women to go back 2 points, it just means that we are slipping at a far faster rate, and that we're not the priority. So I think it just drives me a little bit more aggressively to continue doing what I do. We put out lots of free financial literacy content, and this is obviously why we love She's on the Money and being able to have these conversations. But I think that there are a lot of communities that are missing out on these conversations as well. They might not be into podcasting, they might not have access to the internet in the same way that we do, or they might just be in communities that have conversations about money. They might be, a little bit abstract to that. So I think there's a lot more research to be done to work out how we can fix this and how we can actually help get women in particular up there.
It's so true. I like the point you make about, and everyone needs to tell everyone about She's on the Money and all the great resources they have. It's like a community is really there to spread. And it's really interesting what you say about COVID. If I think back about when I studied, no one's taught really budgeting at school or financial literacy. It's like
No, but I can do trigonometry.
Exactly. But it's like, and then COVID hit. It's like, when did I find out about that sort of stuff? When I got a job, washing dishes at the cafe, babysitting, walking a dog. Like, that's when you were, oh, actually, I'm paid this amount of money, and if I want to buy that, that means 4 hours of my time, and you start getting it. But COVID, a lot of people, particularly in that younger age, couldn't get jobs, couldn't go out and learn those things. So there's really there's lots of gaps of knowledge, I think, which kind of COVID is going to continue to bring on us, which is something we need to address. I think another question, Victoria, for you: do you think financial literacy has decreased because people are kind of just giving up on the great Australian dream, owning a property? What's the point? You know, the boomers had it better. It's really tough now, and just say check out.
Yeah, I absolutely think that that's the case. I feel like it's interesting as well, because if we look at debt levels, boomers are and have been in more debt than millennials ever have been, especially when it comes to personal debt. I just think that a lot of millennials are feeling really disenchanted. I have this conversation basically on a weekly basis in my community, about how the goalposts are shifting, and this great Australian dream, unfortunately, isn't going to be the great Australian dream anymore. And we really need to reframe what financial freedom looks like for the coming years, because as much as I would love to think that each and every single person in the country could purchase a home, it's actually just not that feasible. And to be honest, even if I got you to a point where you had a deposit and you were ready to go, that doesn't actually mean it's the best financial decision for you as an individual. And that, especially with rising interest rates, that needs to be taken into consideration. We really need to be talking about, okay, well, you've got this dream to have your own home, but what does that actually mean? How does that actually work? And does that actually put you at a disadvantage? And I have historically worked as a financial advisor and had to have these hard conversations with people where, you know, I might sit down with a woman in her late 40s. She's just gone through a divorce. We're talking about, you know, her financial goals. She wants to get back on her feet. I want to help her so much. But then one of her goals is to purchase a home and buy a house of her own. But when you do the maths, it actually doesn't stack in her favor. And you kind of have to sit down and go, look, as your advisor, I can't advise that we go down that route because you're going to be at a disadvantage. And I would actually much prefer you to have financial freedom than I would for you to say that you're a homeowner. So I think there's a lot to it. I think that we are quite disenchanted as a demographic, because it is upsetting to think that now property is 13, 14 times an average annual salary, whereas historically for our parents, it was 5 or 6. So I think that can be really upsetting, but I think if we can reframe it and go, well, we can actually achieve financial freedom, we can actually achieve things and have a successful life. It doesn't have to mean property. That can be really good. And I think this idea of when in doubt or when feeling a little bit uncomfortable or unsure of your circumstances, zoom out is a good idea. And if we look at the global economy of home ownership, there are so many countries around the world where home ownership is never going to happen for people. In fact, renting is the norm. And I think Australia has a lot to do to catch up to the standards that renting affords people in other countries as well, so that we can have that sense of security as well, because a 12-month lease, if you're never planning on, you know, purchasing your own home, sometimes isn't enough nowadays.
Yeah, that's so true. And just goes to the point of like talking to someone who's licensed to provide financial advice, who can give you really impartial advice on actually what's best for your future and talk around those options with you is really good. And yeah, the great Australian dream should be different for everyone depending on their circumstances. Thanks for that, Victoria. The next question that people were asking us about is like, you know, how and when to review your finances. So it's the start of the year, lots of people have New Year's resolutions to set out a plan to review their finances, to do certain things. We wrote a blog about that, so you can read it later. But Victoria, you're great at this and explaining it in a way that really resonates with people. So I'm really keen to hear from you what you think reviewing your finances means in practice. How often should we do it? What sort of mix should we have between, you know, savings, investings, and fun?
Yeah. So when it comes to reviewing your finances, there's no set, this is how you should do it. It can be one of those things where we actually have to sit down. And my favorite topic, and I promise if you're like me, you might want a glass of wine to do this because it's going to be a long evening, or a nice cup of tea, or just like sitting comfortably on the couch. And I know I care deeply about the environment, but I find that the best way to do this is honestly to print your bank statements out and then get 2 different color highlighters and then highlight your discretionary items versus the things that you can't change. And when we go through it like that, we're not trying to judge ourselves. We're not trying to look at it and go, oh my gosh, Brendan, I spend so much on this, this, and this. What we're trying to do is get a really good understanding of what a budget is, because a budget is not aspirational. A budget is literally what's coming in and then what's going out, being able to understand that. And I think too many times we sit down to do a budget and we go, all right, let's do a budget. I know I earn $60,000 a year. So you break that down. And then you start allocating it and you say, I know my rent is $250 a week. Do you know what I want to do? I want to spend $100 a week on groceries. And that's quite aspirational because we haven't fact checked what you're actually spending. If you're spending closer to $200, to slash that in half and go, all right, well, Brendan, now you have to spend less than half. That involves significant lifestyle change to make that happen, and it's not sustainable. And what we need to do is take that judgment away and go, all right, what we need to do is look at, what are you actually spending? Oh, you're spending $192. All right. Are you comfortable with that? And you go, yeah, I'm such a foodie. It's all I care about. I don't want to change my budget when it comes to food, but look over there. That's my gym membership I don't use. Or those are a few streaming services that I really don't log on to. Maybe we can cut back there, or maybe we can cut back in a different area that actually aligns to your values. So the first thing I would do is that, and really understand what's coming in and what's going out. And then regardless of whether you've got debt or not, I think that every single person needs to have an emergency fund. So an emergency fund is your get out of jail free card. It's the ticket that makes sure that if something unexpected comes up, you can get out of any circumstance and any situation without being stressed. It also means if an unexpected cost comes up and you're already in debt, you don't have to then rely on that debt cycle to get you out of that circumstance. And that can be really disheartening, where you might have a $5,000 credit card that you're paying off and you've only got like $600 to go. And then Rego pops up and you're like, oh my gosh, this is the worst. I was feeling so good about this. And all of a sudden I've got to put $1,100 on my credit card again because I just don't have the cash. So regardless of whether you're in debt, I do genuinely believe that people should have an emergency fund, because it creates good financial habits, but also means you can get out of any circumstance or situation that you don't want to be in. And then we're really looking at debt. We want to smash down all of our personal debts and make sure we understand what that looks like, and make sure that we don't actually fall back into the trap of getting into more debt. And it can be quite stressful when we look at it, because we judge ourselves and we go, oh my gosh, I'm so silly, or I'm so dumb for getting into this. And as somebody who has literally had more than $30,000 worth of personal debt, I can talk from experience that that's exactly what we do. I buried my head in the sand and did not want to talk about it. I would literally tell people, no, I've never been in debt before, while I was in debt, because it was, to me, really embarrassing. But had I had those conversations, I just know I would have been in a better position, and people actually really support you. So trying to get out of debt is the first thing I would do. And then understanding that budget side. Well, how much surplus do you have? What are your goals for investing? I think one of the biggest questions I get, Brendan, is what should I invest in? I go, hold up. What are we investing for? How long are we investing? What are your goals? What are your values? Like, what kind of platform are we looking for? And I think that we need to understand our goal for investing before we actually dive headfirst and go, oh, should I get this ETF, or should I buy a direct share, or what does this look like? And I feel like too often that's the sexy bit, like that's the fun bit, right? Picking what you're doing, being able to tell people. So understand what that means. Understand the time frame on which you're going to invest. Are we investing every week? Are we investing every month? Are we investing every quarter? What does that look like? And if you're based in Australia, please don't forget about your superannuation. If you're an employed person with a tax file number, you have a super account and you are already an investor, and you need to care about that money. That money is your money that you have complete control over, that is creating financial freedom for your future.
All good points. I think that emergency fund one is super important, like back to being a cat parent. And if you've got very little friends in your lives, I mean, every time our cats go to the vet, they want to take another couple of teeth out, and wow, teeth at the vet, that's expensive.
I didn't realize how expensive cat teeth were. And like, small flex from cat mum over here, my cat Bailey is nearly 12 and he still has all of his teeth, but he gets his teeth cleaned every year. And I didn't realize that's like $450 because they have to be sedated to have that done. What?
No, should have been a vet.
I know, right? They make bank.
Yeah. But I love my job, so I don't want to be a vet.
Yeah, okay. Sorry to the Sharesies management team, please stop listening.
Exactly. They're always listening. Another question we get about, which is a really valid question, I think, is like, how do you invest in a market downturn? So again, we've got another article for you there. But let's hear from Victoria. Anything that you should do differently when reviewing your finances during a potential recession? You know, the markets go up and down and sideways. We never know what's going to happen. Or when the economy feels like it's on a downward trend. Any kind of comments from you?
Yeah, now is the time to really top up your emergency fund. And I'm not here to try and scare you and say, oh my gosh, top up your emergency fund, the world's going to trash. It's actually just going to give you a lot more peace of mind. We never know what's going to happen. We already know that the cost of living is going up here in Australia, and that can be quite stressful. So knowing you've got a little extra cash hidden away in case something pops up or things are a bit more expensive than you had anticipated is never going to be a bad thing. The other thing I want to talk about when it comes to investing in a downturn is this idea that it's scary and fearful and that, you know, you're going to miss out. And we learned a lot during the GFC when, jokes on you guys, I was actually still at school, but I can learn from history. But during the GFC, which was in 2008, 2009, there were obviously a lot of people who lost a lot of money for a lot of different reasons. But one of the things that happened during that time was really fearful people who had investments and maybe didn't fully comprehend how the investment world worked. And what they did was they maybe had, for example, 10 shares, and each share that they bought was worth $1. So they had a share portfolio worth $10. And then over the next, few months, they started to see it crash. They got really, really stressed because they're like, oh my gosh, my share portfolio is now worth $5 instead of the $10 it was. What do I do? Do I just take all of my money out right now? Because if I do that, then I'm just, quote, saving what I've still got left. And that's actually the wrong mindset to have, because what they weren't seeing was they still actually had 10 shares. They never had less than 10 shares. And that $5 valuation isn't actually what you have, Brendan. It's what it would be worth if you sold it that day. So anytime you log into your Sharesies platform and you might be looking at it going, wow, it's a bit down. No, it's a bit down if you were to sell it today and crystallize that loss and actually accept it. And a lot of the time, and please don't get me wrong, as an ex-financial advisor who invests personally, I still get anxious when I look at my investment portfolio and go, oh no, like it's going down. And then I kind of have to slap myself a little bit and be like, Victoria, you're meant to know better than this. And you do, but it's human nature to worry when something seems off. Like, it's not normal to feel cool when a market is going down. But what we have to do is overlay education and go, no, I understand that over the time frame of my lifetime, I'm actually going to see 7 market crashes. Like, the average human being in 2023 is going to see 7 market crashes in their lifetime. It's going to happen. It's going to return. Everything will be okay. The point of the thing that we want to talk about when investing in a market downturn is actually, what opportunity can we seize? What can we do here? If you're in the lucky financial position where, we might be headed into a recession and you still have a solid income, you still have a really safe job, and you do have some surplus cash, well, what can you be doing to make the most of that at this point in time? It's funny because if you went to the shops and Brendan, you were like, oh, there's a 20% off sale. You'd be like, oh, great. Like maybe we'll just have a look. I wasn't planning on buying anything, but it's 20% off. That's a pretty good deal. Like no plans. But when the same thing happens in the share market and the market's off 20%, people lose their minds instead of seeing an opportunity to purchase something that might be undervalued. So from my perspective, investing during a market downturn is an opportunity, but we also need to make sure that we are financially stable and that our financial house is in order before we go trying to seize an opportunity. Because the last thing I want you to do is invest in something that you then have to pull out because you're financially stretched.
Exactly. And there's this beautiful chart by Vanguard that shows.
Oh, it's so sexy. Yeah.
Stop money. I know. It's like I'm going to get it tattooed on my arm.
No, you can't, because it updates every year and it's interactive and it's like the best thing in the entire world.
Yeah. And it's awesome because it shows like it's 100 years or maybe a little bit more of 100 years, and it shows every crash or correction or everything from the Great Depression to GFC to 9/11 to every sort of war and COVID when it hit. And it kind of shows the dips when you're in them and it's down 30%. You go, wow, that feels. I'd open my Sharesies account and see it in the red, and it's like. But you look at that, and as you say, you zoom out, and you're like, actually, the graph increases year on year. And if you look at the average return in the share market over 10 years, it's probably about 9.8%, including dividends. But in some years, it's going to be negative, and some years, it's going to be more than that. But over time, if you can keep regularly investing, don't worry too much about the price. I love your analogy about if something's on sale and you're in a position where you can invest a little bit more because you've got everything else sorted, your emergency fund and everything. It's not bad to keep that like $50 a week investing or $10 or something, because over time, that compounding power of investment returns is magic. And so if you can just keep doing that, not get worried. I think I saw a Warren Buffett quote in the comments. When other people are fearful, that's the time to kind of get into the market. Like there's opportunity, and if you think a company, if you love a company, if you buy their products, if everyone else buys their products and the share market price is a bit lower than usual, that price, remember, is just people, buying and selling. It's not the actual value of that company. And if you've got that, management's great, the economy, they set up the economy, it's like, it could be a decent thing to invest in. So don't be fearful, I think, is the
No, absolutely. And it's insane as well. We have started saying in the She's on the Money community, when in doubt, zoom out and look at the bigger picture, and that can really help. But it's funny as well talking to first-time investors, because obviously we're meant to zoom out and they'll have a look at their portfolio and be like, oh, what's the point? Like, I've been doing this for 6 months and I've only seen a return of X. It's like, I need to stop you there, and I don't want to be condescending or rude or disheartening, but like, you can't do that. Like, you can't just look at 6 months and think, oh, it's going well, I'll stick to it, or it's not going well at all, I'm going to give up. You actually need to have in the market, and this is going to be overwhelming for some people, but to really see compounding interest take effect, it takes 7 years. It's the rule of 72. And I usually say to my clients, like, it's going to take about 10 years to like get there. But after that, it really, really compounds. Like, it's going to go from 12 grand to, 50 to 100, and you're going to see it grow in a way that you can't even comprehend. And I think that the share market is an interesting concept as well, because, talking about compound interest, it's one of my favorite things in the entire world, because it's your money that your money makes, and then your money makes money on that. And again, that's really sexy. But humans think in a really linear way, like 1 + 1 = 2, 2 + 2 = 4, etc. Like, we only just think in this way. Whereas the share market, when we start to actually take compound interest into effect, it goes like this. And we can't comprehend that as humans because we don't have a brain structure that comprehends that. And I think that that's really interesting to take into account as well, because so many times you're trying to explain the importance of investing, and they're like, yeah, so you're saying I'll have double in 10 years? I'm like, yes, but we need to even look bigger than that, because in 30 years, it's not double anymore. It's not triple. It's way more than that. So anyway, as you know, I could go on and on and on about this forever because I'm obsessed with this topic, but I will hand back to you, Brendan.
But it is really magic. Like, I mathematically know compounding returns, but I just, like you say, the human brain can't comprehend it. I think I'll get this wrong, but Warren Buffett made no, 99% of his fortune in the last 5 years of his life because of those investments he made, and he's worth a lot of money. But that was like 30, 40 years of just solid investing in companies where he saw the value. And then it's in this last bit where it's just gone bang. And it's like, keep the habit up. Make sure you've got an emergency fund so you don't need to crystallize any of those losses or gains or anything, and just keep it going. It really is like,
and play with investment.
Yeah,
play with compound interest calculators as well.
Yeah.
Like the Money Smart one is one of my favorites just because it's a government-based like platform that everybody kind of knows they can go to and it's safe. But it's interesting being able to go, all right, well, what happens if I invest $50 a month? And you see over 10 years, it might look like this, but then over 30 years, you go, wow, this starts to really change people's lives. And I was having this conversation around superannuation that if you're in a circumstance where, you know, you've got an extra $50 per month to spare. As a female, we actually retire with about $300 or just under $300,000 in superannuation, which is not nearly enough. But if you are in your 30s and you started investing $50 a month, you can actually double what you retire with. If that's not putting the power back into your hands, I don't know what is. And I think a lot of people would just go, well, $50 not enough. Like, that's not going to change my life. But over the long term, like, the power of that is insane from my perspective.
Yeah, I agree. And then some guides for us on, if you loved what you heard then, sign up for our go-to guides on how to invest in a market downturn. That QR code will take you to the link where we'll send you some emails on all that, or you can jump on the website and pop in and sign up for those. So Victoria, again, your budgeting journal, everyone go out and buy it. Buy two. I'm
biased, it's great.
It is, it's very good. I haven't started filling it in yet because I'm just, those interest rates, like, are they ever going to settle? Anyway, that's a question for another time. So Victoria, your top 3 budgeting tips. I know it's a lot to take a whole journal and compile it down to 3, but over to you.
I feel like top 3 budgeting tips was actually really easy. And I say it was easy to pull together because these are the first 3 things I just want you to do, whether you have the book or you don't. I just want people to be in control of what they get up to. So the first one is regularly review your expenses and feel really in control. So if you're regularly reviewing your expenses, this doesn't sound big a lot of the time. It can actually be really life-changing because if you're on top of what's coming in and what's going out always, you're going to have far more control of your budget. You're going to feel a little bit more opinionated about it. We're not talking, hey, sit down every single week and go through your budget, but just like have an idea of what's going on. Have the banking apps on your phone so you can scroll through and see what direct debits are coming through. I mean, I do this when I'm on public transport, so I can go, oh, what's going on here, here, and here. And I mean, I'm obviously a very big budgeter. I love a good spreadsheet. I don't think anything can beat it. But I do think that regularly reviewing your expenses means, one, you really comprehend what's coming in and out, but you're actually actively choosing to always put your financial literacy and your financial life first. And so many times people can't be bothered, or they can't think about it, or they just don't want to, or it's too boring. But doing that is really the first step towards creating financial freedom. The next one is really have a good idea of what your goals are. So we go back to, and I've seen a couple of the comments in the questions that are like, well, what about buying a house and investing and stuff like that? It's before we even look at how much money we have coming in and how much money we have coming out, I think we need to talk about what a long-term and a short-term goal is. So a short-term goal might be going on a holiday to Bali with a couple of friends later this year. It might be buying a new car in 12 or 18 months. It might be, you know, saving for a home deposit because you want to purchase in the next 2 years. Whereas a longer term goal might be, oh, I know I'm not going to purchase a home maybe for the next 10 years. I'm going to start saving a deposit over here for that. Or it might be just creating financial freedom, but having an idea of what those goals are. And then subsequent to that, what are those goals actually going to cost you? How do we work backwards from this? How does that actually fit into what we want to achieve over the long term? Because I think so many times we set goals for ourselves that are unachievable. And if you go, all right, well, Brendan, I want to save $10,000 this year. And you go, oh, V, that sounds really reasonable. Like, that's a good goal. Hope you can achieve it. Well, if I haven't sat down and worked backwards and worked out what that's actually going to cost me every single month, I'm actually going to end up at the end of the year feeling really disheartened because I didn't achieve my goal. I thought I was so silly because I didn't understand, that that wasn't achievable for me. And instead of going, wow, I didn't set that goal up correctly for myself, the internal monologue is, I'm so done with money. I can't save. I tried to save even 10 grand and it just didn't work. And the reality of that circumstance is you weren't set up for financial freedom and actually to achieve that goal. So work on your short-term and your long-term goals. And then the last one is actually just be really kind to yourself. Nobody's perfect. No plan is perfect. I promise I have transferred money from my savings account back to my spending account before. And I think anyone who says that they haven't done something with money that maybe they quote shouldn't have, they're just not human. I feel like it can feel really overwhelming, especially when you're in a circumstance where, you exist online, in TikTok, on Instagram, where everybody seems to have these perfectly curated lives where they're saving for their houses and they're buying their houses and they're sticking up their big yellow stickers that say sold. I think so many times we forget that, one, nobody is perfect, but two, you don't understand other people's circumstances. Like, I was talking to my mortgage broking team the other day, and they were saying something that their clients are coming up against at the moment is that they're feeling really disheartened because, they've been saving for years to buy their first home, and then their mate goes and gets it and they weren't even saving. And I think that one thing that we don't understand about other people's goals is how much help they had or what actually is behind that, because you might have a friend who didn't want to talk about her finances, but she's saving since her first job at 14 to buy that house, but didn't really want to talk about that because money makes her feel a bit ick. Or maybe her parents were really successful and said, you know what, we'll just be your guarantors, no worries. We can't compare ourselves to other people. I think we need to kind of put blinkers on and be really kind to ourselves and go, well, what does my journey look like? What can I do? What can I achieve? What can I do every day to be just 1% better financially than I was yesterday? And that will serve you very, very well, as opposed to just always comparing yourselves.
I was just, when you're talking about that, that's like great advice for life. Even it's like, so not only in your finances, if you have a little hiccup, it's don't get disheartened. It's like exercising, training, anything. It's like, it really does. And you don't know what's going on with other people. So it's like, don't give up. Like, just as you say, work out what's personal to you and go for it. Always learn so much from you, Victoria.
I also feel like it's so easy being like, as a human being in her 30s who loves TikTok, loves Instagram, I feel like I forget my financial goals sometimes because I get so swept up in the aesthetic life of somebody else. I watch them and they're doing this one thing and they're working towards this, and I go, well, maybe I want that too. And it's small things, but I really think that we need to remember to put some blinkers on and go, yeah, Instagram and Facebook and all of these social media platforms are highlight reels, and people are only ever going to show you the best parts of themselves or the best parts of their lives. Because why post if not to show off? But I think, I think keeping an idea or even just a journal of what your goals are and what your plans are is really important, because it can be so easy getting swept up in the goals of other people. And that could even be you saying, oh, I really want to buy a house, because your older brother bought a house and your parents keep asking when that's happening for you. And then you sit back and go, actually, this was never a goal of mine. This was just kind of put over the top of me. What do I want out of life? And I think that's a way more important question.
Exactly. ETFs, exchange traded funds. So we've had a few questions about those. So ETFs are often a really usual part of someone's investing journey when they first start out. And we had a bit of a webinar at the end of last year and saw that ETFs are still by far the most popular investments on the Sharesies platform. And there's so many of them, thousands and thousands. I just wanted to ask you, Victoria, based on all those ETF options out there, how do you even start? How do you even think about what to invest in?
Okay, so what you do is you just go and pick fund XYZ. And I think that's what people want me to say, right? They just want to be told what ETF to purchase or what asset to go and buy. And I think that we can get analysis paralysis. Even looking at this list, you've just listed 10 different types of ETFs, and that goes, oh, hold on, that's the most popular buy in value, and oh, that's how many people are picking this. And you can see easily that the Vanguard Australian Shares Index ETF is high on that list, and you go, well, maybe that's the one for me. Scrap that, put it all in the bin and go back to your values. Go and sit down and go, well, if I'm investing, what's the point? Why am I investing? What am I trying to achieve? In a perfect world, if I was to go and select an ETF, and we all know that an ETF, an exchange traded fund, is basically like a basket of shares that gives us instant diversification. What do I want that to be made up of? And you might go, oh, I'm really into the tech space. I'd really like a lot of tech companies. Or you might go, oh, I don't really know. Maybe a good range of just good Australian shares would do for me. Or maybe I really want like global ethical companies. So I think thinking about what that looks like first and having a chat to yourself about what that's made up of is going to be essential. The next thing is to talk about or think about whether you're an ethical investor or not. Is it important to you that some things aren't included in your portfolio? This can be quite topical because there's no actual one definition of what ethical means to another person. It's actually quite personal. You can go down the route of having a portfolio that's, quote, green or clean or whatever we want to call it, but I would have a look at it and make sure that it aligns to your values. The next thing is risk. How much risk are you taking on? Have you actually done a risk profile for yourself? Are ETFs even the thing that you should be putting your money in? Because the thing with the risk and reward chart is the more risk you take on, the higher the potential reward, right? But you might be really far down on that risk reward chart, and the type of asset that suits you might actually be a bond or a term deposit or something that is a lot more conservative, because maybe when it comes to risk, you're not ready to actually jump out there and go straight into an ETF. So if you understand risk and what you're willing to take on, I think that puts you in a far more powerful position, because when it comes to risk and return, if you're a more conservative investor, well, a more conservative asset would be an Australian ETF as opposed to a global ETF. We really need to think about these things and then go back to the drawing board. And what this does for us is kind of creates a reverse triangle, and you kind of start at the top and it's like a funnel. You go, I've got all of these options. Oh, okay, I do want it to be ethical, and it gets a little bit skinnier. And then you go, yeah, actually, I think I do want it to be in Australia. That's what I want. And it gets a little bit smaller again. And then you go, all right, well, what type of company do I want to go for? What kind of do I want to go for a VanEck or a Vanguard, or are we talking, iShares or Beta Shares? Like, what are we looking for? Do I want maybe a really left field ETF created that no one's ever heard of? No, I probably want something a little bit more, stock standard that is tried and true and tested. And it gets smaller and smaller. So then when you do go to look for an ETF that aligns to your values, you actually end up with 3 or 4 options that make sense, and you pick from those instead of looking at what everybody else is doing.
Good points. And jump on. We've got a few blogs on how you choose an ETF, and I know that you've done a lot of great work on that too, Victoria. So you don't feel overwhelmed by the choice, everyone, but like Victoria said, kind of systematically go through and look at it that way.
I wish I could just tell you and say, all right, Brendan, this is the perfect asset for you. But that involves some very serious thought. It involves a whole finance document. Like, it involves creating a statement of advice and understanding what are your goals, what are your plans, what are your ethics, what are your values, what are we trying to create, how much money do you have, all of those things. So I think it's interesting as well, because even a financial advisor, when I was working as an advisor, there was no one go-to product that I'd put every single client in. Like, I wouldn't go, all right, well, guess everybody's getting the Vanguard Australian Shares ETF because you're all about this age. It would really depend on who they were and what that meant to them and how that would work. So I think that's a good piece of information to know as well, because I think people automatically assume, well, a broker or a financial advisor would have this information. They're just gatekeeping it. And it's just not the case. Like, it's not how it works. We actually just need to find the asset that works for us the best.
Exactly. And then so we've had some questions about kind of dividends and all that sort of stuff. So as we probably know, you can make money two ways when investing. So this goes for ETFs or normal company shares. So there's capital growth when you buy at a certain price and then the price of that asset raises, like buying a house and the house price goes up, or dividends, which, if we're talking about a house analogy, that's like getting rent on a house. So lots of people ask, well, how can you tell what companies, what ETFs provide dividends? So we've actually got functionality on the platform which provides that to you, and we've got Melissa to give us a little demo of how you can find that.
If a company you invest in makes a profit, it may choose to give that profit back to its shareholders in the form of dividends. Now, you might be wondering what a dividend yield is and why it's on the Sharesies platform. The gross dividend yield is all the dividend payments for the past year per share divided by the current share price, shown as a percentage. It's important to remember that the past performance does not guarantee future returns, and this applies to dividends as well. But the gross dividend yield percentage can show you a representation of the historical returns in relation to the current share or unit price. To put it in even simpler terms, some investors use this as one way to measure the return of an investment that pays dividends. It's important to know that not all investments pay regular dividends. They might decide to reinvest the money instead of paying it out as a dividend. Sometimes they might even decide not to pay dividends at all, even though they've done it in the past. If you're on the Sharesies platform, you can check it out by heading to your chosen investment. We're going to pick this one here. Then we're going to scroll all the way down and head to gross dividend yield. From here, investors can see any upcoming dividends and a snapshot of the past dividends. Pretty neat, hey?
Thanks, Melissa. So yeah, go in there, check out if dividends are important to you. We're trying to save some time for a question, so I'll rush through this quickly. If you're not on the Sharesies platform already, use the code webinar, get $10 straight out of my pocket to start you on your investing journey. We've also got some product updates for auto invest. Now you can create up to 3 auto invests. So that's where you regularly put your investing on automated. So it's just dollar cost averaging through it. And you can personalize those do-it-yourself investment orders, name them, put a little photo up. It's quite great. So let's get on to Q&A. And if we don't get a chance to answer your questions today, we'll pop the answers to most of the popular ones in social. So apologies up front if we don't get you. Cool. Victoria.
Yes.
Let me get started. What's the hardest question I've got here?
Oh, thank you. Thank you.
A good one about platform fees. So lots of different platforms out there, lots of different types of fee structures. How do you go about evaluating those platform fees? What's a good fee? How do you choose? What do you look for?
Yeah, so when it comes to platform fees, I feel like I'm a little bit opinionated on this because I do genuinely believe if you play peanuts, you're going to get monkeys. So we actually do want to pay fees, and every platform that exists has spent a lot of time working out what their fee needs to be to cover administration, make sure the business keeps running, make sure that their people get paid and that you're getting the service that you deserve. So it's usually something along the lines of, it's either a set fee or it's a percentage per trade. We need to take into consideration the lots of different fees that could exist. So are you paying brokerage per transaction? Is it a monthly fee? What does this actually look like? But from my perspective, fees are something that we take into consideration, but it's not the be all end all. Like the platforms that I exist on, and I do invest on Sharesies, as you guys already know, I look at it and go, okay, no worries. Like that makes sense for that. It just changes the way that I invest. So if I wanted to invest every single week and I go, wow, like I'll be paying brokerage on that. Well, that doesn't make sense to put money into the market every single week. What I might do instead is just pop it in a savings account until I have a certain amount and then make one trade so that I'm making the most of that brokerage fee. And that's important to understand as well, because I think a lot of people, when we're talking about dollar cost averaging, they assume that fees mean that, oh, it's silly, like I can't dollar cost average. But you can actually dollar cost average quarterly. Like you could do it once every 6 months. The plan isn't to have every single day as an investment day. It's actually just to make sure that we're always in the market at different points in time and that we're always consistently contributing. And that might be over a different period of time. In my second book, Investing with She's on the Money, you guys have already seen this, but for those of you who haven't read my book, I actually do a fee breakdown of the different platforms and what their fees are and what their benefits are, because I find, and you guys probably see this a lot as well, I find that a lot of people are comparing apples with oranges. Like they might go, here's this micro investing platform, their fees, and oh my gosh, look at Sharesies fees. And you're like, that's not comparing apples with apples. Like that's a micro investing platform versus a DIY investing platform. So I think that we really need to work out what we are doing and then whether we're getting value out of it or not. But as I said before, genuinely believe if you pay peanuts, you're very likely to get monkeys, and fees are not the be all end all. It's actually about ultimate return.
Yeah, and some platforms have like a minimum investment, so you need at least $500, or we can invest from 1 cent. So there's lots of different things. Now fees are 1.9%, and we've got it capped at Australia at $6, so you'll never pay more than $6. But different platforms, have a look at all of them, work out what suits your needs. So lots of questions about what to invest in, which we won't talk about specifics, but kind of again, what do you look at in a portfolio? So if you are getting on in your investment journey, you think, I kind of understand diversification, risk, what other things should you look at when you're creating that portfolio for yourself?
Your risk profile, 1,000,000 times over your risk profile, because your risk profile is kind of like a pie chart, right? And we draw this pie chart and it might be empty right now, but you go, Brendan, and you do your risk profile and you come out as a really conservative investor. That means that your pie chart is going to be divided up into maybe like 25% Australian shares, maybe 25% international shares. You might have then some bonds, and then like there might be a large portion of cash as a suggestion in your investment portfolio. And so diversification comes in a lot of different ways. So obviously, if we're buying Australian shares, we want to make sure that we are diversified across Australian shares, but then there's also diversification inside our portfolio to make sure that we're meeting our risk profiles. So if you're a conservative investor, you might hold more cash than somebody who's an aggressive investor. And if you look at a high growth investor, for example, their portfolio, this is just all from memory, but their portfolio might be made up of 1% cash and then maybe 85% international and Australian shares as compared to a conservative investor. So when it comes to portfolio construction and like what should we pick, it actually really depends on what you already have and whether that aligns to your risk profile. So are we adding Australian shares because you already own some international? Do you already own an investment property? So you're actually really saturated in investment property and you probably should add some shares. Do you have a really high amount of cash, but you keep coming out as an aggressive investor? What do we need to change there? Is it actually about mindset? Is it about where we're going and how we're going to achieve that? So when it comes to portfolio construction, it actually comes down to who you are and what you want to create. And I really wish I could sit down and tell everybody, this is what you need to do, this is how to do it. It's just not the case though, because one Australian ETF might have a different risk profile than another Australian ETF. Like no investment is made equal. It just really depends on what you want to create and how you want to create it. So I think once you can really comprehend that, you actually get given this, your risk profile, and you have a pie chart and you go, all right, well, let's start there. What my portfolio is telling me, or what my risk profile is telling me, is that I need to have 50-50. I need to have half international shares with a little bit more risk and half Australian shares. Let's start looking there. And you might go, all right, now what asset do I want? Do I want direct shares? And you might go, no, Brendan, direct shares are a little bit too risky because to actually get good diversification, I'd need like $100,000. I need to be able to go out and buy, $10,000 worth of NAB and $10,000 worth of this and that to actually create a well-diversified portfolio. But through an ETF, I can get instant diversification. Okay, well, maybe I'll pick an ETF that works for me and my risk profile and my values and my goals, and we'll call that the Australian portion. So I think when it comes to portfolio construction and like how do we make that, it's going to be really different depending on who you are and what you personally want to do.
I mean, I've got a bit of a hot tip about portfolio. So I think someone who will remain nameless, my husband, is on Sharesies and is investing in, 10 to 15 different ETFs, and really excited about that. And I said, well, you're investing in 10 to 15 ETFs. Do you know what's in each of those ETFs? Because actually, you're not really getting diversification, because if those ETFs are based in Australia, it's all the same companies.
Yeah.
And so there is that kind of thing like, think about it, because diversification is really important in a portfolio. Like you say, every portfolio is kind of personal, but it's things that you're you're interested in that match your values. But also be careful, like look into those details. You can have a look in every ETF and see their top holdings, all their holdings in fact, and kind of why they do that. So that's important to do as well. Don't just think because you've got lots of things that's necessarily the greatest thing on the platform. The average holdings of people is maybe 3 or 4 ETFs and then some companies that people particularly like or are interested in. There's not people with a lot of holdings, so it's kind of a handfulish. Let's have a look. And rebalancing. So you set up your portfolio, you do all the hard work, you think about your risk profile and all that sort of good stuff. When should you look at rebalancing it? And what is rebalancing?
So rebalancing is making sure that your portfolio's assets are still returning what the plan was. So rebalancing is kind of just a process that you go through, and I recommend that people do it maybe once every 12 months. You don't need to do it all the time, maybe once every 12 months. If nothing's really changed about your life or about the market, then maybe every 2 years. But it's essentially a process of returning the values of a portfolio's asset allocations to the levels that were defined by that investment plan. So if you had a portfolio and the plan was to have 25% in Australian ETFs, and then you wanted to have 25% in global ETFs, over time, if you're consistently investing that $50 a month, it's going to be added to something. And it's going to go somewhere, and you might be picking randomly, you might be picking, just the Australian ones. Maybe Australia is a little bit better as a market. So you're like, let's just chuck it in there. It's a bit discounted at the moment. So then you go in and you might find that your ETFs are now sitting at 30% Australian and it's now 20% international. Rebalancing is making sure we go, all right, does that make sense for me? Or should I revert back to what the original percentages were to make sure that I always have not only good diversification, but a good balance across the portfolio so that I'm still adhering to my risk profile. So rebalancing is really important. I think that a lot of people make it seem really confusing because they're like, oh, you need a financial advisor to rebalance. That's not actually the case. It actually is just going back to your values and what you were trying to create and achieve in the first place and making sure that portfolio is still on track to do that for you. And yeah, that's basically it. It doesn't have to be this really hard process, but yeah, it's basically realigning the weighting of a portfolio's assets to make sure it's in line with your original plan.
Cool. And then one last question, and this is one I struggle with all the time. If something that you've purchased is not going so well, so it's underperforming a little bit, but you understand the time value and being in the market and all that sort of stuff, what sort of circumstances would you consider to sell that underperforming ETF or company share?
Yeah, look, I would be going, all right, if my share is underperforming over 6 months, probably going to leave it and see what happens. I'm also going to do some research and understand why that's the case. So I think a lot of the time we freak out and we don't do anything because, oh my God, it's performing really badly. Let's zoom out a little bit. What's happening in the economy? Yeah, are we headed towards a recession? Because that could be a really big indicator as to why our portfolio might not be, working in the way that it is. At which point you might go, all right, well, maybe I don't need to dispose of this. Over time, though, if you have picked a share that you're like, oh, this is a pretty good punt or this is a pretty good idea, I'm not really sure, long term, you might pick a share and then ultimately decide to pull out of it after doing your research and realizing that it doesn't adhere to your values anymore. They might have had a company restructure that you don't really agree with. They might have sold to another business that doesn't align to your values. They might have done a lot of different things, but the key here is actually research and looking into it and not just going, well, hasn't performed for 12 months. I'm going to dip out of it. And there's an example of this actually in my personal portfolio. I'm not telling you which share it is, but in my personal portfolio where I had so much conviction because I'm quite conservative, but I do have a portion of my investment portfolio where I like to have a little bit of a fun with, right? So given I am in the markets every day, sometimes I hear about things that I'm like, oh, that would be a little bit of fun. I'm going to have a bit of a punt. So I jump on Sharesies and I purchase it. And I waited and waited and waited and it wasn't performing. It was making me really sad because I thought it was going to perform. Anyway, I was like, maybe this just isn't going where I thought it was going to go. Maybe I do need to cut my losses and just give up. Like, I just don't want to hold something for this long. So instead of doing that, I went and read their annual report, and their CEO had actually been really sick and everything had been put on hold for a while. So obviously the business wasn't growing in the way that I had anticipated it to. I've held on to it and now it has recovered, and I am very happy that I stayed in it. But had I not done that research, I would have found myself in a position where I exited an asset that ultimately I didn't understand the reason why it was performing the way it was performing. So if a share's not going well, I think that there's a lot that you can do, but ultimately I would be making sure I understand the market and what's going on in the economy. I understand the bigger picture, and that you're not just being a little bit trigger happy or being triggered by anxiety or being scared of the market. And then at that point you can go, you know what, maybe this isn't performing for me well. The interesting thing there is usually this question only comes up around direct shares, because when it comes to an ETF's performance, an ETF usually has somebody running that ETF to make sure that if something in it isn't performing well, they're going to boot it out on your behalf. And that's one of the values or one of the benefits of being in an ETF or a fund where there is a manager whose job it is to make sure that performance happens. So I think that there's obviously benefits to being a direct investor if that's what's in line with your values, but there are also so many benefits to going into an ETF that makes sense for you.
Although saying that, I had an ETF that was not going very well and I hung on to it a little bit longer than I should have.
Did you boot it in the end?
I did. The good thing about investments which go down is it's a tax loss. That's how I justified it to myself. And I learned a lot during the way.
100%. And tax losses can be carried forward, guys. I'm not an accountant. Whenever we talk about tax, I have to disclaim that, but I'm not an accountant, but you can carry forward your losses so that they can be offset to any profit that you make in the future. So as much as it sucks, and I mean, we don't want to be losing heaps and heaps of money, but like we can use it in the future to make sure we're paying less tax on the money that we do make.
It's a little gift. Taught me a lot of things, that one.
Little gift, a little negative gift.
That's right.
A backhanded compliment.
That's right, exactly. Well, I could talk to you all day, Victoria, but I'm afraid our time's up. So thank you, everyone, for joining us today over the break. Lots of questions there. Cool. Thanks, everyone.
See you.